So I'm going to talk a little bit about what Bitcoin miners can learn from portfolio management. And I would assume the majority of the people in the room here are not Bitcoin miners, but you are typically investors, portfolio managers, and so you understand the theory of portfolio management. And what I'm going to try to kind of in very simple terms explain is how Bitcoin miners can apply that same type of thinking to their operations. Safe harbor statement. Obviously, we're a public company, so forward-looking statements, et cetera, et cetera, et cetera. So most people have expectations on Bitcoin mining that, oh, Bitcoin's going to go to the moon, it's going to be worth $1 million very soon, we're going to hold 100% of our Bitcoin, we have really cheap electricity, we have abundant capacity, and we have limitless access to capital. That was 2021. When Bitcoin was going to the moon, everybody held all the Bitcoin they produced. Electricity was still fairly cheap. There was abundant capacity, and there was tons of capital, and lots of capital was raised. Lots of Bitcoin mining companies went public, raised a lot of money. The reality is there's a lot of volatility. This is an industry where 50% of the time you're borderline break even or not making money, and 50% of the time you're printing money, and you think the world's never going to end for you. In the good years, your price of electricity, which is your single biggest input cost, doesn't even matter because your margins are so high that if you're paying 2 cents, 3 cents, 4 cents, 5 cents, it really doesn't matter. In bad times, it kills you. And there's margin compression. 2022 was one of these years where we went from an industry which in 2021 at its peak had 80, 90% margins, everybody was very profitable, you really couldn't go wrong. Then the tide went out, and a lot of people were left without any swim trunks on. And you had energy prices because of the Ukraine conflict that were doubling, tripling, quadrupling in some cases, and the price of Bitcoin fell by 75%, all of which created a perfect storm. You had bankruptcies. One of the largest miners, publicly traded miners in the US, Core Scientific amongst them, declared bankruptcy. They were operated in a model where essentially they gave their customers fixed cost on hosting, and they had variable input cost on their power. And when your energy cost goes way above what you're billing your customers, you run into problems. Then there are also operational challenges with energy, getting permission to connect your miners, dealing with regulators, as well as just systems quality issues, et cetera. And then there are macro factors. Today you heard 3 very esteemed economists talking about their outlook on the macro world. Well, Bitcoin is very much driven by the macro environment. The value of the US dollar drives Bitcoin. Interest rates, which drive the US dollar, drives the price of Bitcoin. Risk on, risk off attitudes drive the price of Bitcoin. Bitcoin mining as a business, though, is also very much impacted by energy costs, as I previously mentioned, but also by something called the global hash rate. The Bitcoin network, for those of you who don't know, awards miners a fixed number of Bitcoin per day. It's a zero-sum game. Doesn't matter how much I mine or how much somebody else mines, that same number of Bitcoin will be produced every day. And there's a concept called the difficulty rate, which is essentially a calculus that the Bitcoin network does automatically, which says, I will produce a block every 10 minutes. And no matter how many people are mining, I'm going to make sure that nobody is so good that they can solve a block so that the block rate goes faster than 10 minutes. And so it automatically adjusts every 2 weeks. And I'm simplifying this a little bit. But essentially what happens is in the good times, people say, wow, this is great. I'm going to go buy lots more miners. I'm going to mine more Bitcoin, and I'm going to take market share. Well, when everybody does that, the global pool of people doing this might be applying twice as much compute power as they did the prior year, but there's still the same number of Bitcoin being awarded. And so you're having to deploy twice as much capital, pay twice as much for energy to get to the same spot. And then every 4 years, you have this thing called a halving, where the number of Bitcoin awarded to miners drops by 50%. And today we're at roughly 19.3 million Bitcoin mined, and there will only ever be 21 million Bitcoin. And so every 4 years, the number of Bitcoin miners drops. If the price of Bitcoin goes up by 2 every 4 years, most people would think, oh, well, that's fine, because it typically has. The problem is this difficulty rate and global hash rate. As more people mine Bitcoin, it gets harder and harder to do it. And so even though the price could double every 4 years, in reality, it has to more than treble, nearly quadruple, because people keep buying more miners to do more mining. And it continues to grow. And in the past 2.5 years, we have more than doubled the mining capacity in the network, which means that even though the award rate of Bitcoin hasn't dropped by 50%, effectively, if you didn't buy any more miners since 2021, you would be producing half as many Bitcoin today as you were in 2021. So it is a very challenging business. But when it's done properly, with good risk mitigation, it can be extremely successful. So how can miners bridge the gap between the expectation of this business where you're going to get rich, Bitcoin's going to go to the moon, you're going to hold all your Bitcoin, and it's super profitable, with high energy costs, very volatile price of the asset that you are mining, and this constant increase in difficulty? So Markowitz developed a concept of modern portfolio theory. Essentially, instead of looking at individual assets and basing your investment on kind of individual assets, look at portfolio theory and instead allocate based on risk-adjusted returns so that you, no matter what the environment you're in, get a good return. And I'm overly simplifying it, and I'm sure that if Larry Summers were in the room listening, he would take me to the bench and say, listen, you got to take my class at Harvard. But diversification of investments can reduce risk, and especially the total risk. And again, remember, Bitcoin is profitable 2 years out of every cycle, and it's not profitable or it's break even 2 years out of every cycle. So you have to optimize your business model such that you can operate come rain or come shine, and you have to optimize your capital stack such that you have the right financing at the right times, and you're not sitting upside down with high interest rate debt when the market crashes, which is what happened to a number of miners last year. So asset class returns can increase as their risk increases, but you have to be careful. And so if we look at kind of Ray Dalio's perception on this, conventional portfolio risk can be very focused on equities or a single asset class. But if you have an all-weather risk portfolio, you're spreading that risk. And for private investors, the 60-40 kind of concept of allocating between equities and bonds was kind of the view on portfolio risk diversification. For institutional investors, it's obviously much more complex. But essentially, the goal here is if you're going to be a Bitcoin miner and you want to operate using portfolio theory, you need to have a diversified business model that allows you to operate when times are lean very efficiently, but also allows you to grow very quickly when times are generous. And at the same time, have a way to carry a lot of value on your balance sheet so you're able to finance your growth when times are good. So how do miners use this framework to build their mining portfolios? So if you think about how miners operate, they're typically two flavors. You are either building and operating your own mining operation, you contract directly with the power company, you lease land, you buy land, you build the infrastructure, and then you operate it yourself. Or you use third-party hosting, where you contract with a data center operator, essentially. And they build it, they operate it. The only thing you do is buy the actual mining rigs, deliver them to that operator, and then they run them for you, for typically a fixed fee or a fixed operating overhead cost, and then pass through on the power. The third-party hosted model works great when times are good and you need to move quickly, provided there's capacity, meaning that there's availability of space, because you can just buy miners, give them to an operator, they plug them in, they operate them, and you only allocate capital to buying miners, which is where your biggest return is. Because if you look at a typical Bitcoin mining operation, about 30 to 40% of the capital goes into the infrastructure, right? It's transformers, it's containers, it's buildings, it's everything you need other than the mining rigs themselves. And then the balance is the mining rigs. And if you can spend all your capital on the mining rigs, your return is going to be much greater than if you're having to spend 30 or 40% of it on infrastructure, because you have more cash to invest in mining rigs. That was the model Marathon used in 2021 and 2022, very much a third-party hosting model. But the problem is there's risks with that. What happens if your third-party hosting partner goes bankrupt? Ours did, for example. Compute North went bankrupt. What happens if power prices go out of control and your partner hasn't hedged for it properly? So in lean times, it's much better to be self-hosted where you can control everything. But in generous times, you want to be able to grow as quickly as you can and maximize the return on assets when you grow. With third-party hosting, you can be very lean. Marathon, the end of last year, had 7 exahash capacity, so say 2 to 3% of the global hash rate, and we had sub 25 employees, where most of our peers had 100 employees for similar sizes. The self-hosted model requires more OpEx. You have to have more employees on site operating it. So it means more of a fixed cost. But again, in lean times, you have the ability to more control what you're doing. You can focus on efficiency versus effectiveness. The self-hosted model, though, has challenges from a geographic flexibility perspective. Typically, it makes sense to concentrate your resources in one location so that you can have the lowest amount of OpEx per megawatt of power. So you want to have big sites where you can have a medium-sized team, and if you're going to build another site, build it within driving distance of the first site, ideally. Problem is, that creates concentration risk, because what happens if the community where you're operating decides they're going to change the rules on Bitcoin mining? What happens if the electrical utility changes something? So you don't have geographic diversity necessarily in a self-hosted model unless you specifically plan for it. With the third-party hosted model, it's very easy. I'll work with a partner in Texas, I can work with a partner in North Dakota, I can work with a partner somewhere else. Your return on assets in the self-hosted model can be much greater because you're stripping out the margin that the hosting partner would normally have earned. And in the third-party hosted model, you're obviously paying somebody to take all that infrastructure risk that you didn't want to take. And as I mentioned earlier regarding bankruptcies, the jurisdictional and regulatory risks are much greater with third-party hosted than they necessarily are with self-hosted, because in the self-hosted, you typically have agreements with the power companies, the local communities, whereas you have to trust your third-party hosted partner that they've done it properly. So third-party hosted has advantages from a CapEx perspective, but it doesn't quite have the same advantages from a return on assets. So what's the ideal model? Well, the ideal model is a diversified portfolio. So if you think about a traditional investment portfolio, you may have fixed income, typically bonds, equities for having alpha, stocks, alternative assets, real estate, for example, private equity. You may have commodities as a way to hedge inflation, and then you would hold cash. Well, as a miner, you can follow a very similar model. You can do some self-hosted, which gives you operational efficiencies. You can have some third-party hosted, which gives you the ability to grow rapidly at the right times. You can have what are called REC-producing sites. RECs are renewable energy credits. So this is a concept where if you think about energy being your single biggest input cost as a miner, imagine you are sited at a location which is a renewable energy generating site. Imagine if you're capturing methane flare gas from an oil field. That methane is 80 times more damaging to the environment than carbon dioxide. You can get renewable energy credits, or even better, RINs, which have a higher valuation, which can be easily traded on the market that can subsidize your electrical costs and lower your energy cost to almost zero in some cases. So that's a way to hedge your costs. And then you can hold your Bitcoin, like owning gold, for example, so that you have ample reserves on your balance sheet. Now, some people would think holding Bitcoin on your balance sheet is risky because when the price of Bitcoin drops, it loses value. But when the price of Bitcoin goes up, it gains in value. What's the benefit of that? Well, if when you're going to grow, you initiate that growth primarily during upticks in the market, well, then your balance sheet keeps going up in value because of the Bitcoin you're holding. And though it's counterintuitive, it typically takes anywhere from 9 to 18 months to grow in a self-hosted environment, whereas it can take 6 months to grow in a third-party hosted environment. So the time value of growth benefits third-party hosting if the market's in a growth cycle. And so that's why you want to have this evenly balanced kind of certain amount of self-hosted for efficiency, certain amount of third-party hosted for rapid growth. And you want to keep a balance sheet full of Bitcoin as much as possible, and then cash, obviously, to operate. The challenge is, in today's environment, compared to 2021, you have to be able to do this without carrying a lot of debt, and you have to have access to capital markets for growth capital. And what that means is that if you look at the universe of miners out there, scale becomes hugely beneficial. If you don't have scale, you don't have optionality. Because if you don't have scale, the capital markets are more limited. You definitely don't have access to debt markets. You don't get preferential pricing on the equipment. It's a lot harder for you to negotiate with partners. And you just don't have the balance sheet to do it. And so as you look at mining in the future here, over these next cycles, and we're about to go into a halving cycle in May of next year again, really only the strong will survive. And I think you're going to see a consolidation of kind of the biggest players, not necessarily through M&A, but simply through attrition of the smaller players. And I think what we're going to continue to see here is the miners that have access to capital, that have good liquidity, that have low debt on their balance sheet, and that have the ability to grow, are going to continually grow and take a greater and greater share of the global hash rate, and the smaller miners will not. So, in summary, kind of adjusting your capital allocation based on what's happening in the market. When times are lean, you want to have a lot of self-hosting. When times are rich, you want to use third-party hosting as an advantageous model. But you need to be careful to have a proper balance of the two. And you want to hold your Bitcoin through the right times, and at times sell your Bitcoin. Today, for example, Marathon will sell Bitcoin to cover operating costs because the weighted cost of capital is very high today. Where in 2021, it was very easy for us to raise money in equity markets, or debt was very inexpensive. It made no sense for us to sell our Bitcoin when Bitcoin was going up. Today, though Bitcoin has gone up nicely this year, debt is very expensive and equity is highly dilutive. And so instead, we will sell part of the Bitcoin we produce to cover our operating expenses and hold the rest. Where prior to the end of last year, we held every single Bitcoin we produced, which is one of the reasons why of publicly traded companies in the US, we're the second largest holder of Bitcoin. And it provides us a lot of strength on our balance sheet today. So, you need to be diversified and you need to have scale. And I think that's, if you look at the mining space, those are the miners that are going to have the best chance to be successful, not just through this cycle, but also to the next cycle and the cycle after that. So, any questions?
I was wondering how you deal with your banking relationships. There's been a lot of talk about choke point 2 with the US beginning to cut off crypto businesses to the banking network, but also with the bankruptcies of Signature and Silvergate. So how do you approach that? And are you finding it an issue with your business?
So banking for crypto-related companies is a challenge. We banked with both Silvergate and Signature. With Silvergate, we had credit lines where we pledged our Bitcoin and had and borrowed money against it for a revolver and a term loan. Luckily, we paid those off at the end of last year and early first quarter this year. So we were already disengaged from Silvergate when their problems happened. But in the case of Signature, we had a 9-figure amount on deposit with them that luckily we were able to move. But where before we would have 2 or 3 banking relationships, today we have nearly 10. You have to have diversity. And the other thing, I think that the economists may have spoken about today is instead of holding cash in current accounts, we now have a portfolio of short-term treasuries, other bonds, things like that, where we're keeping minimal amounts of cash actually in the bank itself, but rather we're using instruments that are essentially liquid with low risk, as well as Bitcoin in our balance sheet. Great.
Thank you. First question is one moon. The second question is a serious one. Once you've mined the Bitcoin, do you diversify that into any other assets, like Ethereum, for example? And are you potentially interested in looking at, earning yield on those assets, Ethereum and DeFi, et cetera?
We don't. So from a perspective of digital assets, we only hold Bitcoin. There's risk with Ethereum, with staking and now being destaked, regulatory risk. It adds additional volatility. I can hold Bitcoin and I can sell call options, for example, that are out of the money on my Bitcoin, generate more yield than I can by lending it out to people. So that's just more of a hedging strategy. But we don't hold anything but Bitcoin. We don't mine anything other than Bitcoin either. Oh, sorry.
Oh.
I don't control the microphone, so go ahead.
So with hash rate becoming less and less profitable and more commoditized, does Marathon also plan to use other financial hedging strategies than just like holding and selling?
So as I said, we can sell calls on Bitcoin. We can do collars where you have puts. The problem is that typically the economics on those don't really make sense. For us, it's really all about putting our capital to work with miners and just continuing to invest and grow to either maintain or grow our share of the global hash rate. Okay, I think we are done with questions, but I can stand on the side and answer any questions anybody has. Okay, thank you very much.